and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome to this episode of the Open Treasury podcast, Paul and Ben.
Thanks for the invite, Push.
Yeah, thanks, Push. Always a pleasure.
Oh, you're very welcome. Thank you to you both in abundance for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. Let's dig deeper and get your perspective on our topics for today, namely digital payments taking center stage within U.S. corporate treasury and finance. ICC and Swift launch API standards for bank guarantees and standby letters of credit. Surging credit card delinquencies in the US, and finally, Bank of Japan's chief says pace of Chinese economic activity could cloud Japan's economic outlook. Our audience can read articles, interviews, and industry roundups by visiting ctmfile.com or by following the links in our show notes. Let's start today's discussion with our first story for today, which is about digital payments taking center stage within US corporate treasury and finance. Treasurers and CFOs are making a continued shift towards investing in payments modernization, particularly in prioritizing digital payments. Statista findings indicate that the US digital payments market is being driven by digital commerce, mobile point-of-sale payments via smart devices, and digital remittances, which include online cross-border payments. Paul, upon reviewing the US digital payments article published on CTMfile, what areas within payments, according to you, are expected to exert a significant influence on US corporate digital payments in the near future?
Yeah, Push, I think the findings by McKinsey were illuminating in terms of kind of what I expected. 9 in 10 Americans are now using some form of digital payments, noted in the article here. What's more interesting is the disruptions that we've had over the past several years that are noted here in the bullet points of the article. I think these have had a huge impact on the way business is being done. The pandemic, disruption of supply chains, the interest rate hikes because of economic turmoil that's been occurring on a global basis. Things have been changing, and it's put people in a position where okay, the exchange of cash is not hand-to-hand anymore. It's a necessity to do this from an electronic basis. Think about COVID-19 and everything being shut down, and how do you get groceries? How do you get supplies that you need for day-to-day living? It became you went online, you made an order, you purchased via some type of debit or credit card payment, and that's the way you got resupplied. You would drive up to the store, somebody would bring it out to your car, you'd drive away. So you never actually went in the store. And so it kind of changed, I think, people's perception in the US around digital payments. What is, I think, going to transform digital payments in terms of more of this real-time concept is FedNow is up and running as of July this year, and real-time payments, the adoptability or acceptability of those, I think, is going to continue to increase. So I think within the U.S., we're going to see real-time payments take front and center stage over time. I don't know exactly how quick the adoption will be, but I imagine that it's going to pick up steam over the next 5 years and become a significant portion of what's happening from a digital standpoint. The other thing that I think will have an impact here in the US, and I know just writ large, there's still a lot of groundwork to be cleared and laid and understanding of how this will be managed, but central bank digital coin I think, is the next thing on the horizon. Asia is ahead of the US in terms of acceptability or adoptability around that. But I think once the US and UK in particular as well get to a point that they understand those parameters, feel like security and control is in place, that our central banks will get a level of comfort and central bank digital coin will become a reality. So I think everything's gearing and moving towards a digital wallet or a digital platform to make payments. And the US is getting, I think, primed for that next step.
Yeah, I completely agree with Paul. There's no doubt that digital payments is definitely a growing trend in the US. And I think, the launch of FedNow is a clear milestone on that journey. We've previously spoken on the podcast, Push, about how the thousands of smaller banks in the US all have a relationship with the Fed. So access to FedNow could be simpler for them than signing up with the clearinghouse's RTP network, for example, which in turn brings real-time instant payments to small-town America, which would be huge. For corporates, it will be interesting to see how the different approaches banks take in enabling APIs for FedNow, because if it's anything like the variety of approaches seen with RTP, it could be a challenge for corporates with multiple bank relationships to adopt real-time payments. They'll need things like bank aggregator connections and ultimately some semblance of standardization to really make the most of it. The second point that Paul touched on around the CBDC in the US, I think the point in your article around the dollar's role as the world's reserve currency is spot on. So the US naturally has to be quite cautious as it dips its toe in this in the CBDC stream. That said, earlier this month we did run a story on the site that outlined the potential for such CBDC from a pilot by the Digital Dollar Project, which found out, some positives that could come from a digital dollar, such as reduced risk, instant settlement across multiple currencies, reducing counterparty and credit risk for customers and their financial institutions, and also optimize costs, improve customer experience, and also the visibility over the payment. So the positives are there. It's just having that sort of balanced approach, making sure that if and when a US CBDC is brought in, it's done so in such a way that it doesn't negatively impact the dollar or surprise and shock the economy in some unforeseen way. So it's a really interesting sort of tightrope that the US, I think, specifically has to walk in that regard.
Yeah, no doubt, Ben. That's good comments. That's probably why you haven't seen the U.S. move at a faster clip regarding digital coins from the central bank. It's one of those things where if you weren't the world reserve currency, perhaps that becomes a little bit easier conversation. But that's the position we're in. I don't see that changing anytime soon, even with the things that China is doing to be an alternative acceptance or acceptability of reserve currency. I don't see the U.S. waning to the point where it's less of a concern in the near future. So they've got to wade those waters and make sure they do it in a systematic way that's not going to disrupt things from an economic standpoint. I also want to come back to your comments on FedNow and the ability of these small local banks to have access to real-time payment platform to be able to do that. That really is it's a huge thing here in the U.S. because we had about 2/3 of all the banks, roughly, had access or the ability to do real-time payments. Smaller banks can do that. They couldn't afford to do that. And now FedNow has opened up that door. All of them can participate today. And so that's a huge step forward, especially when you think about rural communities. I live in Iowa. We are a ag state. We have tons of farmland, and we have very small communities all over. And now this is something that's big for those small-time banks, where there are people that in rural Iowa that like technology and accept it. And so, you will see a step up in use, a platform like FedNow through their local banks. So it's a big step forward writ large for the U.S. Digital payments are going to continue to grow in acceptability in the way that we make payments. Barely carry any cash today, and when I do carry it, it's usually I'm exchanging something with a friend versus with a merchant or a business. So having hard currency in my hand, at some point I see that just completely going away.
Yeah, I know what you mean. I paid for dinner with a friend the other day, and they gave me cash to cover their half of it, and I'm going to be carrying those £10 notes in my around in my wallet for quite some time, I think.
How interesting that cash is now becoming more of an anomaly and digital payments is on the rise. On that note, let's move forward to our next story, which is about the International Chamber of Commerce, or ICC, and Swift launching the first application programming interface, or API, industry standards for bank guarantees and standby letters of credit. The collaboration brings together ICC and Swift members, including banks, corporates, fintech platforms, and service providers, to create industry standards to streamline the entire life cycle of financial instruments, including issuance, advising, amendments, cancellation, and claims. Ben, you covered this story for CTMfile. So, what, according to you, would be the key benefits of these API standards that could accrue to corporate treasury?
Thanks, Push. Yeah, it's a good question. And this is a really interesting story, I think, because we talk, particularly in the last year, 18 months, quite a lot around the topic of API standardization. I mean, it even came up in our first story on today's podcast. So this particular example, as you said, is in the trade finance world, and specifically for bank guarantees and standby LCs, or letters of credit. The fact that the standard API that the ICC and Swift have put together aligns with both the Swift MT message standards and ISO 20022 is smart, because it means it can start to be adopted now, but is also fully compliant for the big switchover to ISO 20022 that the financial services industry is working on right now. I think in the end, it is adoption that will decide the fate of this. Adoption by corporates in time, but I think more urgently by banks, fintechs, and service providers in the trade finance space. I would expect to see Swift promoting this at the annual Cybos conference in Toronto next month to try and drive that adoption. So corporates need to see that banks are using this to make multi-bank interactions far more efficient in the trade space. And also with digital trade finance, is quite a trending topic. I think the interoperability that standardized APIs can facilitate between the banks, and also the growing number of digital trade finance platforms, is critical. So I think this is a positive news story.
Yeah, it absolutely is. When you think about things from a supply chain standpoint and the way that they finance their operations, I think this is just another step forward to making that whole process more efficient. The ability to have access to capital to get materials through supply chain. This kind of platform, this API approach is going to help that. And my experience has been that from a corporate standpoint, the ISO 20022 compliance, corporations are moving towards these platforms, these standardized formatting. And so I think from a corporate standpoint, this is just going to make that speed up from my perspective. They're going to move towards it quicker. So definitely a welcome step forward from my standpoint, and from a trade finance standpoint, I think this is really huge for them.
A welcome move and a welcome step. I couldn't agree more. From API standards, let's move on to the third topic for today, which is surging credit card delinquencies in the US. Credit card balances in the United States have surged past $1 trillion for the first time, according to newly released data by the Federal Reserve Bank of New York. The rise in credit card debt aligns with inflationary pressures and increased consumption levels. According to Wells Fargo, late payments on credit card balances are also rising, which could be a harbinger of difficult times to come in the US economy. Rising late payments put more pressure on small and medium-sized banks, strategists said, during a time when markets have been increasingly concerned about bank stability and rising debt levels in the US. Paul, credit card delinquencies may be associated with the consumer or retail side of banking. However, the upswing in credit card delinquencies have also been historically associated with recessions, although a downturn hasn't yet been officially declared. So, from a corporate treasury perspective, is the rise in card delinquencies something to be concerned about?
Well, Push, I think it's definitely something that you can't ignore. And to your point, whether it's credit card delinquencies or car loan payments or student loan payments, these things that, here in America, we often utilize as ways to fund access to either goods or services. When you see a rise in delinquencies, that does draw concern. And so you've got to pay attention to what's going on with that. What's interesting in this article is that it hasn't necessarily pointed to that there's wide evidence of financial distress from a consumer standpoint. So the consumers continue to chug along. At some point, that will be exacerbated. So when that happens, I don't know. I feel like the consumer has been driving the stability of the economy here in the US at a level that wasn't necessarily anticipated. And, myself included, I sat on the sidelines for a while, and it feels like we had a significant amount of pent-up demand that when the pandemic occurred, people held back. They held back a little bit longer when things started opening up. And now they're to the point where they're feeling like, hey, I can get back to doing things again. So doing things meaning they're taking trips, they're remodeling their house, they're buying things that they had thought about buying before but haven't. So they're out there purchasing goods and services that they put off for a while. And to fund this, many times people will use credit cards to fund it. Wage growth has been extremely positive in the U.S., which has helped continue to fuel the inflation concerns that we've had with the Fed raising rates, trying to slow that down, get employment in check. And with the wage growth has also, I think, allowed the consumer to say, hey, I can still do more things. They've extended themselves, and delinquencies are starting to occur because it's caught up. So the question is, how significant or how severe is it? Should we be completely concerned that delinquencies are occurring? I guess the question would be at the rate and totality is what you want to keep an eye on.
Yeah, I think corporates can look at this story as a data point. It's, as you said, introducing the topic, Push, credit card delinquencies can be a warning sign for incoming recession, but obviously there are lots of other different data points that can signal a potential recession. Things like the yield curve to employment figures, retail sales, industrial production. So it's just kind of taking on board this knowledge, not panicking, but just being able to put it into context. And also, if it is an alarm bell for a possible recession, it's a good opportunity to review your policies and your operations. Indeed, running some scenario analysis, for example, around what a recession would mean for a particular position that you might have, or looking at core treasury fundamentals, overlaying your current operations on top of that, and understanding what an impact of a negative economic situation might have, what preemptive actions the Treasurer should be thinking about taking in order to best protect the cash and the overall organisation. I think in the $1 trillion story, the one point in there that was interesting was household debt, the number on that going up over $17 trillion in Q2. So that might be potential concern. If there's a knock-on effect of that debt, meaning that consumer spending is then dragged down and is sluggish, that could then trigger further dominoes to fall in the wider economy, potentially curbing economic growth. So it's just something for treasurers to pay attention to and making sure that they're forewarned is forearmed. So doing all that analysis, avoiding the potential to make knee-jerk reactions to something, and just having an understanding of what actions might be in the best interest of their organisation should an economic downturn hit.
Interesting. From rising US credit card delinquencies, let's shift the conversation to Bank of Japan's chief saying the faltering Chinese economy could cloud Japan's economic outlook. Bank of Japan's governor has commented that the pace of economic activity in China has been a disappointment that could cloud Japan's economic outlook, according to a text of his speech delivered at the recent Jackson Hole Symposium in the US. The underlying problem appears to be the adjustment in the property sector and its spillover to the rest of the economy, Bank of Japan's governor said on China, adding that impact on Japan of China's weakness has been partly offset by the relative strength of the US economy. Japan's economy grew 1.5% in the 3 months to June, according to official data, beating expectations on the back of strong exports. Ben, if you were a corporate treasurer with considerable exposure to Japan and China, would you be concerned with Bank of Japan governor's statement that the stuttering Chinese economy can weigh on the export-reliant Japan? I mean, if the world's second and third largest economies get impacted, wouldn't it add to global supply chain issues and economic uncertainty?
Thanks, Push. Yeah, possibly. I mean, it's understandable, I suppose, having a huge economy, two huge economies as near neighbours will always have some level of impact on the other. I think the main point, and you touched upon it in your question, from this story that I wanted to pick out was the governor commenting on the trade and foreign investment flow, suggesting that Japanese firms are diversifying production from China into the rest of Asia and the US. And we've spoken quite extensively about how the US economy might be in trouble. But here the governor's suggesting that the relative strength of the US economy has actually helped Japan negate some of that weak economic data from China. So it's not all doom and gloom in America, which is nice. It's a positive country, so I'm glad there's some positive feedback from other countries for the US. I think naturally other Asian countries such as Bangladesh, India, Malaysia, Thailand, Vietnam, they're all sort of offering alternative manufacturing bases for corporates that are looking to diversify supply chains away from China. So for treasurers and finance managers looking to boost supply chain resilience by reducing their exposure to China, they'll need to review their sourcing strategies, I think. Where is the organization's global footprint? What do they need and where, and in which countries are the most efficient for their supply chain needs? In this example, it could still be China. They could find that that's still the best way of doing things after a review. Or they might explore some of these phrases that I don't like very much, but they're becoming common parlance like friendshoring. So shifting sourcing towards more compatible countries, or nearshoring to bring sourcing a little bit closer to home, or even just reshoring and setting up manufacturing within their own country of operations. We've all seen supply chains become quite a bit more flexible since the pandemic. So for treasurers, it's just the need to analyse if there could be a more efficient way of managing the supply chain, as well as ensuring that all the cash they're generating can be efficiently brought back to the centre from wherever the operations are stretching to. So I think it's under consideration, particularly if you have exposure to those countries, but it's something that I think is reviewed relatively often, particularly, like I said, since the pandemic.
Yeah, Ben, I think those are good comments. Bank of Japan, they recently kind of made a position in terms of where their rate targets are. What's interesting in Japan is, unlike the US is trying to fight inflation. Japan wants to continue to see inflation occur because they haven't had it in so long. It's been decades. They've been stagnant. And so they're concerned, I believe, with, what's going to happen with economic activity in China slowing down. How's that going to impact Japan? And so smartly, they're looking at how they can diversify to weather the storm. Doesn't mean that you completely go away from China and Japan. If I'm a treasurer, how do I manage the exposure or the risks associated with changes in the economic environment? Obviously, there are some potential global ramifications with what's going on in China today. But I think, Ben, to your point on onshoring, nearshoring, friendshoring, I don't see that going away. I think supply chains realize that they need more flexibility in a changing global footprint. So I think this diversification will end up being a good thing. It doesn't mean there's not pain along the way. The question will be is, what kind of impact does that have on Asia? Is it that a rising India now becomes a center point for more manufacturing and trade? Could that happen? It certainly could. There could be more infrastructure coming there. It certainly could be that, from a U.S. perspective, there's a trending scenario of manufacturing coming back to the U.S. where, we're going to have to train people in new ways of doing things because we haven't done it in so long. That's not a bad thing. And I think maybe from a global standpoint, it's going to be the new norm that you have to have this certain level of diversification. So I think from a treasurer standpoint, it's making sure I understand the global footprint, the trends that are occurring, so I can manage risks appropriately so that I can optimize how I manage cash from a global perspective as well as, from a local standpoint. Making it efficient and optimizing it will help treasurers be more successful in the job that they have.
Yeah, I completely agree that having a diversified supply chain is critical, particularly these days. It's one of the big lessons that we've learned from the pandemic. It's just don't have all your eggs in one basket. And that gives you the flexibility to potentially be able to turn on and off different parts of your supply chain in order to sort of react to situations as and when they occur. So I think that's definitely something that we're seeing and something that we'll see more of in the next year, 18 months.
Those are great points, Paul and Ben. Finally, what is your choice for the biggest or most important story of the past week and why? Paul, can I ask you to go first, please?
Yeah, there's lots of things going on out there right now. We've got a hurricane hitting Florida. We've got a typhoon that's making its way towards Hong Kong. So we've got large storms that are going to have financial impacts on countries. I was reading somewhere that Warren Buffett had a bet on maybe a calmer tropical storm season this year. It's not shaping up to be that way right away. But from a standpoint of where my focus is more local for me is U.S. economy and what the Fed's going to do. We're seeing that second quarter growth rate was cut to 2.1%. New jobs, the ad was the smallest we've had in some time. So we're seeing some signs that the rate increases that the Fed has been engaging in are having an impact. So it'll be it's not impossible that we're away from rate cuts, but it's looking more and more like this next round will be a hold steady and reevaluate. So I'm thinking the Fed's not going to raise rates coming up here at the next meeting.
Yeah, for me, I'd probably just reprise a little bit of what we spoke on the ICC and Swift trade finance API standards story, because API standardization is such a big issue across a variety of areas of finance. APIs are meant to encourage seamless transfer of data between systems, but if treasurers are having to waste time making allowances for different proprietary bank APIs or spending budget on new technology just to be able to see all their different banks on one platform, then we're just being imprisoned by the technology that's meant to be setting us free. So I think the move by Swift and the ICC is important because it needs cross-industry support from organizations such as these to push through a level of standardization for APIs onto the banks and onto third parties operating in the financial space. So I hope that the industry take up these API standards for bank guarantees and standby LCs. We need strong adoption, and that then hopefully we can see this style of initiative in other areas as well for the benefit of treasurers and everyone else in that ecosystem.
Wonderful. Thank you, Paul and Ben, for your valuable insights, your time, your participation, and discerning analysis. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury Podcast. Please subscribe and look in the show notes for the article links. Thank you so much and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.